Welcome to the Techno Fundamental Report for January the 2nd. We have a focused approach with our investing strategy, and there's a reason because over the years I have found that you really want to look for the highest quality businesses, and there just aren't that many of them out there. So you have to focus on those businesses, and then you buy with conviction. And then you have to take a business owner's mindset. So as you kind of get into what these guys think, meaning Warren Buffett, diversification is a protection against ignorance. It makes very little sense for those who know what they're doing. Peter Lynch, diversification is a useless investment strategy. Owning stocks is like having children. Don't get involved with more than you can handle. So it's a process. Investing in the stock market, unfortunately, you just can't take that broad diversification and make it work. You've got to focus in on the stocks that are working, and most of them don't. There's no use diversifying to unknown companies just for the sake of diversity. A foolish diversity is the hobgoblin of small investors. That said, it isn't safe to own just one stock because in spite of your best efforts, the one you choose might be the victim of unforeseen circumstances. In small portfolios, I'd be comfortable owning between 3 and 10 stocks. So he's saying to really focus in here. Now, I wanted to mention a book that I'm reading right now that is really an excellent book, recommended highly. It's the story of Rudolf Diesel, who invented the diesel engine. And the main message that I'm getting here is that, as it says here in the book, it says, but now diesel's invention was celebrated around the world. A few months before diesel sailed for America, Thomas Edison had called diesel's engine one of the greatest achievements of mankind. I mean, the diesel engine really changed everything. And the main takeaway is that the engine was designed initially for submarines, for the British and the Germans. And so what the takeaway is that a lot of times you'll get these technologies that come through the military and then become, available to the general public. Now, when we're looking at the market, we want to look under the hood a little bit. We want to look at multiple indexes. If you just look at the Dow Jones 30, I don't think you're looking under the hood. So as we get back to our power index, the power trend, this is the power trend. You've got your 21-day here, you got your 50-day. The power trend will end once the 21-day crosses below the 50-day. Well, with the NASDAQ, you can see the strength. Now, the same thing with the S&P 500. We're getting similar strength of holding up better than the averages because if we get into like the value line geometric, which is a 1700 stock, non-market cap weighted index, you can see that the power trend has now ended on the value line geometric. Now, if we go to the equally weighted S&P, you see the same thing. So as you go back and forth and you look at these indexes and realize that all the strength is pretty much in these large cap, magnificent seven type stocks, well, that's just not going to be sustainable. So we need to see these other indexes kick in. Now, I think the culprit here for the market in the last couple of weeks has been the fact that interest rates have been climbing back up again. Here's the mortgage, 30-year mortgage. We're back over 6.8 at 6.85. So mortgage rates really are not coming down. And if you look at the power index, which is measuring the trend of interest rates, so this is the 5-year treasury, you can see it's been climbing, kind of settling down a little bit here. But for the last 125 trading days, interest rates have climbed 3.3%. So that's probably the culprit here that's causing the market to have a pullback. Now, the main trend is still up. We've got the 200-day here for the S&P and the 200-day here for the NASDAQ. So the main trend continues to stay positive. So don't get too negative. Just be a little cautious here. Now, if you look at another indicator, this is the percent of stocks in the S&P 500 that are above their 50-day moving average, and that number has dropped dramatically down to 20%. That means that 80% of the stocks in the S&P are now below their 50-day. So as trend followers, that's somewhat of a negative. Want to see improvement there. New lows have picked up. As you can see here on the New York Stock Exchange, the number of new lows have gotten above 40 here for an extended period of time, which is not a good sign either. But anyway, the main message here is we are in a correction. There is a pullback going on, but the main trend continues to be up. If you have any questions, please let me know.